terms, treasury bills are like IOUs, basically from the federal government to you or to investors, to people who are interested in money market instruments, people who are interested in short-term returns. They are used to settle short-term obligations like payment of salaries, contractors. When you want to put it in academic terms, you say you will say they serve as stop gaps for revenue shortfalls, and in Nigeria the CBN issues them on behalf of the federal government. So let's look at this. In H1 2024, that was in the first half of 2024, the CBN issued T-bills at some astronomically high levels, at levels never seen before. We're talking about 22.49%, 21%, 20%. We've not seen T-bills issued at this rate before. Basically, these yields were so enticing that that particular instrument was a propelling force in the level of foreign capital importation we saw into the country in H1 2024, as foreign investors really wanted to eat out of the Nigerian cake. In the US, you issue treasury notes at 5% rates, while in Nigeria we are seeing these bills being issued at 21%. They were a good buy. Obviously, for observers, it was like these 2024 levels will never be seen again. But what we are seeing, and based on all of that happening between January to May 2024, between the start of January to May 22nd, 2024, we saw the CBN issue 7.867 trillion worth of T-bills. Very high levels. In 2025, the yields have come down and the CBN have been issuing these bills at relatively lower yields. And when you look at it, the highest of any of these bills that was sold is 745.8 billion naira of the 364-day bill that was sold on March 26. That was last 2 months ago. At surface level, it looks like this. At surface level, it almost looks like the CBN slowed down on the issuance of T-bills, especially when compared to last year. However, when you look again, within these 5 months, the CBN has issued about 7.9 trillion of these treasury bills, the highest ever within a 5-month period in history. Is borrowing at this current rate sustainable? That's one of our questions. Is there a better way, or these are just occupational hazards? Have we come into a new dispensation? And on the show this morning, we have Samuel Oyekomi, a research and insight associate who with Norimbaja Group. Good morning and welcome to the show, Sam.
Yeah, good morning, David. Thanks for having me.
So let's start right away. Is there a possibility that we're going to escape this loop, or we have entered into another dimension, or we have started another dispensation of extremely high levels of T-bill issuances?
Yeah, I don't think that we'll continue seeing high levels, because then again, just like you said, in 2024 we saw astronomical levels that we've not seen, discount rate around 21 to 22%. But what we're seeing now in the regions of 19.5, 19.6. So what you're seeing is that those highs are beginning to come down. But of course, they're still attractive to investors. But again, I don't think we're going to see levels of 22 to 20. And just coming on the back of the decisions by the CBN in the last few MPC meetings, they've been holding rates at 27.5. So and that has given an indication to the market that we start seeing some of these yields start moderating. And we've been seeing that towards the end of last year and up until now. So seeing it at 19.6, 19.5, yes, they're already less. And what it means is that going forward, we continue to see it moderate, albeit slower, until when we see a change in terms of the direction of the CBN in terms of monetary policy. But aside that, I think which remain high rate levels, but begin to moderate as time goes on.
Okay, so beyond these T-bills, what other instruments do you think that we can pursue, that government can pursue to plug short-term funding gaps beyond just issuing T-bills?
Well, so for the government, when it comes to instruments, there are limited options, especially in domestic markets. Long term would have been bonds, which we've seen sukuk bonds in recent times, green bonds to expected at some point this year. In terms of short term, options are T-bills and OMO. But I think beyond just instruments and borrowing, there are also reforms that have been on the way for a while now. Look at our revenue basket. where do we earn from? Either we earn from oil exports or then we earn from the non-oil side of things, which is pretty much taxes. And as you would also remember that the National Assembly passed some bills a couple of weeks ago, which is geared towards, or which was a fallout of the tax reform that had started about 2 years or a year ago, aimed at improving tax revenue. I think that's a way to go for the government. But in order to also improve taxes, which is a function of improving the net, the tax nets, improving the collection efficiency of the agencies that are in charge. We also need to create an enabling environment for businesses to thrive. Because when these businesses do indeed thrive, the government can be able to make a lot more from tax collection. So when businesses, big corporations, small businesses are able to improve productivity, increase bottom line, create employment for people, of course, tax revenue is also going to improve for the government, and that will be able to meet up with some of these shortfalls that we have in terms of budgetary and expenditures.
So one of my issues, or one question I would consistently have, is about the level of liquidity that is going towards government issued money market securities. So I feel like sometimes I know that the CBN is trying to make its securities appetizing. That's the word I would use. Appetizing to investors and trying to get as many people into that space. But is it not crowding out capital that can go to the private sector? Basically, is it not crowding out private credits? Can this capital be poured into other capital market instruments like equities? I mean, if we see just half of the volume of capital that goes into T-bills, go into equities, I think we're going to be seeing some very serious action in that space. Or what do you think?
Yeah, interesting question, but don't forget that we are in a high interest rate environment, and the essence of this high interest rate environment was to tame inflation and also to stabilize the exchange rates. So we're coming from a position where our money supply is over 100 trillion naira, and the reason why the CBN has increased interest rate this much last year was over 800 basis points increase in terms of the MPR. The reason is because we want to be able to tighten some of this excess money supply that is in the system. So the action in itself is to discourage borrowing to an extent, discourage the excess liquidity that you have in the system that is set to drive inflation, right? Too much money chasing fewer goods. So if you look at it from that angle, the essence of T-bill also, aside from the fact that you want to attract foreign portfolio investors, is to be able to discourage borrowing from the private sector in quotes, right? To be able to mop up excess liquidity in the system. So that's anti-credit to the private sector, and that is why they call it a hawkish monetary policy stance. So both, you can have both, or you can only have them to relative.
Basically, you can't have your cake and eat it.
Exactly.
Okay, so at this current rate, I have my challenge with the rate. Like you said, you talked about the fact that it's a necessary evil. Basically, we just have to have it like the way it is right now. But can we sustain borrowing? Can the federal government sustain borrowing at this level? We are seeing borrowing rates that are putting, I feel like they are putting some pressure on the fiscal space. Basically, is this a risk that Nigeria has not yet begun to look at or confront? Or what's your take?
Yeah, I agree with you. Of course, more borrowing tends to put a lot more pressure. Just merely looking at it from recent past, look at our budget allocation. A range of 30 to 35% of our budget allocation goes to debt servicing. Looking at data from the CBN alone, January to April this year, we've spent over $2 billion on external debt servicing. That's over 40% of what was spent the whole of last year. And year on year, it has grown over 50%. So it gives you an indication of how a lot more of this borrowing puts a lot more pressure on the fiscal side. But is it something that we would have to live by if we want to be able to attract the level of FPI that helps us to stabilize exchange rates? Yes. Is this a necessary situation for us to be able to mop up the excess liquidity in the system? Money supply is over 100 trillion. They're heading to 121 trillion or so. Currency in circulation is about over 5 trillion naira. So is it necessary to be able to achieve this? Yes. Unfortunately, we've still not been able to see as much of those impacts in terms of high interest rates on those indicators, but it tend to be necessary in terms of what's on paper.
Okay, you are speaking my language when you say unfortunately we are still yet to see some of the effects, because we speak about money supply a whole lot, and yet it keeps going up to astronomical levels. The CBN has probably paused now on hiking interest rates, but okay, now one question I have to ask is about, now, based on all of these high yields we saw from last year, a lot of banks increase their appetite for T-bills. There was like this rush for many banks. The amount of investment securities they began to hold was way more than their lending portfolio. The amount of capital that the amount of investment, especially T-bills, short-term securities, and this trend is also extending into the pension funds area. We've seen a lot of pension funds now increasing their appetite for T-bills. And but one thing that is on my mind, or one question I have, is the fact that pension funds are meant to be long term in their outlook, but these T-bills are short term in their outlook. How do they strike a balance between the two, between the short term and the long term, that is their actual drive or their actual push,
Okay,
especially for
so
pension funds?
typically, right, the pension industry is highly regulated. There's a portion of the portfolios for each of these pension managers that should be allocated to federal government securities. I think it's a region between 65 to 70%,
Oh,
depending on the kind of fund. Again, don't forget we have the fund one, fund two, up to fund six. And the industry is highly competitive. So every pension fund is
just trying
looking
to.
to maximize returns for their clients in a bid to also ensure that they don't have people transferring due to the transfer window. But going back to the data, right, according to the numbers from PenCon, in essence, right, pension funds have actually not increased their appetite for treasury for treasury bills as we would have it. In as much as it seems like it's that way, but it's not in terms of the numbers. So December 2024, the figures was around 754 billion naira in terms of treasury bills exposure. But when
Okay.
you look at their last reported number for March, it was a little bit over 500 billion naira, which means that it has actually declined. What you would find is that most of those funds will go to the likes of bonds rather than treasury bills. And of course, the pension fund is still long term. But again, the level of competition that you would expect from that industry due to the transfer window and the heightened regulation around there, you would find them looking for higher yields, just be able to maximize returns for their clients.
Okay. So what now one question I have is regarding, like, is related to the first question I asked about the have we entered a new dispensation? So some people assume, or some people say, some analysts are of the opinion that the reason why we are seeing bills being issued, like this volume of bills, and I'm not talking about the rates, the volume of bills that have been issued, is probably because the federal government needs to pay back some of the borrowings from last year. Like, it needs to pay back its 1 year borrowing. So we are seeing basically borrowing to repay borrowing. And now the question from me is this going to be a continuous loop, or where do we have a break in the loop, or we're just going to continually see 365-day bills, 1 trillion of it sold? We're going to continue, maybe in the future we'll see 2 trillion of it sold? Or is this an endless loop cycle that we have entered into now?
Yeah, well, so interesting. I think it's a norm, right, for government to raise more debt instruments to repay
To repay
maturities.
old ones,
I
yeah.
think that's like a norm. But of course, there's always a portion of those funds. Everything is not expected to be used for repayment. It's supposed to also meet some of the government fiscal needs in terms of infrastructure and whatnot. But ideally, it's what you find, and I don't think it's unique to Nigeria.
No.
It happens across the world. It's the norm of the financial market. Even normal corporations do that, where they have CPs and they keep taking CPs, Series 1, Series 2, to repay back previous series. It's just a function of their funding needs in terms of equities and capital and debt. And same you have also for government. So we'll keep seeing government coming up with treasury bills, and at the end of the day, it's going to be used to pay back previous borrowings. Unfortunately, that's what we have. And yeah, I don't think that's out of place, right?
Okay. Now, what are your thoughts on last year we saw foreign capital flow into this short-term debt market, basically based on the fact that yields were high, and of course we're still seeing that same trend repeating itself. But are we prepared? Do we have do you think the CBN has adopted any stress test model to prepare itself for a sudden drop? Let's say foreigners decide to exit our T-bill market. Are we prepared for what could happen? What currency pressure, or do you think is it going to trigger a currency pressure? Is there what are the risk factors associated with having a lot of foreigners holding our foreign securities at that level, considering that we're talking about the domestic debt market? This is a domestic debt market that has seen a lot of influx of foreign capital. What are the associated risks?
Yeah, I think that's a very good question. And one of the downsides to having FPIs in your funding needs or in the economy is that they are hot money. They call them hot money, so they can easily exit at any point in time. And I know that the worries of generally of the market is that by the time we start seeing a reversal in interest rates, so right now we're seeing it at levels of 19, but initially it used to be around 9, 11. So by the time we get to the point of 9%, 11% and all, what would happen when these FPI decide to leave? I think that it's not just black and white. It's neither here or there. In as much as because when those funds are expected to leave emerging economies like Nigeria, they're expected to go into some other economies like developed economies. But what you find in recent times is that many of these central banks across the world have been dropping interest rates. So the likes of UK, the likes of the US Fed have dropped interest rate the last time they held. We've also seen same playing in Asia, the likes of
and in the US, the president is pressuring them to drop it.
Exactly. So Donald Trump is also pressuring the US Fed to drop interest rate. And just that by that, you realize that even by the time we start having our interest rate reduced, there's still going to be a net surplus for anyone who seeks to invest in the emerging market. Especially, but the caveat is that exchange rate has to be stable. So if our exchange rate is stable, then there is still incentives for them to keep their funds in an economy like Nigeria, and that could probably just see
so
us.
Leading on what you just said, building on what you said about the fact that the incentive is that the exchange rate has to be stable, but we have a situation where our exchange rate stability is dependent on how much this hot money bring into our domestic debt market. How do we? Is it not time for us to begin to look elsewhere? Is it not time for us to now begin to craft a different strategy to exchange rate stability?
Of course, I think the CBN, credit to them for what it's worth, is that they also have some other plans in place to help stabilize exchange rates based on some of the reforms that they've done from last year. In order to ensure that there's a lot more transparency. And interestingly enough, most of the foreign players tend to look at the level of transparency, how easy it is for me to exit the same way I entered. And that has been put in place. And that ease of entry and exit tend to, drive some level of confidence in terms of the market. The CBN on their own end have also tried, or maybe the government, I'm not speaking for them, but I also know that there are policies in place to diversify the mix. And that's why you see like our reserves are short of relatively in recent time compared to where we are like 4 years ago. Maybe that is a plus, and that could help us drive some level of stability in the exchange rate. But yes, there's still that downside risk. The CBN, the fiscal side, have to do a lot more to ensure that we start attracting the right kind of funding, especially for foreign direct investment in terms of which creates employment, drives economic growth. We would be able to see some level of stability from that end. And then also to discourage Nigerians using excess Naira to chase dollars, because what you find is that Nigerians spending huge, a quantum amount of money on educational tourism, for example, health tourism, and for many other things, even just speculating against the Naira. So if you're able to curb some of this excess demand for USD, Nigerians, we might be able to manage that level of that level of volatility that we've been seeing in the exchange rate market.
Okay, thank you so much for your time, Mr. Samuel Oyekomi. Thank you very much for your insight. It's been a lot. We've broken down a lot and we've gotten a lot of insight. Thank you so much. All right, this is Economy and Markets on Business Day TV. We had a conversation with Samuel Oyekomi, a research and insight associate at Norimbaja Group. He was reporting live from Abuja. We'll be reporting again on Monday on Economy and Markets. Thank you. I'm your amiable host, David Olujimi.